How are you, traders? Good afternoon. Good evening for some, I'm sure. Hope everyone's doing well. Welcome to another live Q&A trading session with Oliver Velez. My name is Oliver Velez, of course. And today, I'm going to be taking your trading related questions. Now, traders, if you're here, you likely know and understand that I do my best to put out a piece of trading content every single day. I do this here, but I also do this on my Instagram and my Twitter and my Facebook profiles as well. So you should be following me there. But sometimes you can't cover, or we can't cover, some of the nuances in a video. And it takes your questions to sort of draw some of those nuances out. So that's really what I'm looking to do, to deepen what I do in video format, right? And sometimes in order for a piece of knowledge to come alive, it needs your participation. It needs you to probe it. It needs you to investigate it. It needs you to go inside of it and pull some of the kernels out. And the way we do that is through inquiry, right? So we use the Socratic method of delving into a topic and arriving at some deeper level of understanding via questioning. All right. So that's what these sessions are about. And so I'm open to answer anything that's on your mind. All right. And if I can get this technology working properly, if you guys want to take a look at something like a chart, what have you, we can try to do that as well. All right. So Sanji is saying, Oliver, please tell me about swing trading. Now, that's a very general point, but I will give you a tiny bit of history here. I am responsible for labeling this style of trading called swing trading. So some people refer to me as the godfather of swing trading because I was the first person to term a specific approach to the market swing trading. So for instance, if you were to Google Oliver Velez swing trading, you will see some of my swing trading work all the way back to the middle or the beginning of the 1990s. That's right. And how I came up with that term was I was doing the financial rounds, doing interviews on television programs and financial programs and things of that nature. And a lot of questions were around my unique style of market play. And one day during one of the interviews, I was explaining it, and the interviewer said, well, sort of like, if it ain't got that swing, right, you don't take the trade. Is that it, Oliver? And I said, I like that. I like that. If it ain't got that swing, which is basically taken from a very popular song, right? So from that day onward, I began calling my approach to the market swing trading, and it caught on. It caught on very widely, and then everyone basically started calling this style of marketplace swing trading. So what do I specifically mean by swing trading? Swing trading is that unique approach to the market that sits between two large groups of market participants, right? So think of two elephants in the room. One elephant is Dumbo and the other elephant is Babar. So you've got these two elephants. Now they're both powerful, but they're powerful in different ways. So Babar is powerful because of his access to greater information, greater research, and greater capital. So Babar is an institutional elephant. You have the other elephant is really made up of all the other individual players. They don't have access to great information. Their training is typically lacking. This is Dumbo. They have access to capital, but in many cases, the capital's not adequate for what they're really trying to do. That group of traders is represented by Dumbo. but can still be powerful if they act together. All right. They may not be acting on the right thing, but still that action has to be respected when Dumbo starts moving around too. So what's swing trading? Swing trading is the style that sits right between Dumbo and Babar. And the time frame is normally something like anywhere from 2 days. I'm going to say 2 days to about a week, week and a half or so. All right. So 2 to 10 days, let's call it that way. That sweet spot, you see, that sweet spot is too short for Babar. Babar can't really play in this 2 to 10 day period. He's too big. His money is too big. He can't turn on a dime that fast. He can't accumulate 88 million shares of a stock and then dump 88 million shares of a stock inside of 10 days. It doesn't work that way. So when you operate in this 2 to 10 day period, you are free of Babar. Babar can't interfere with you. All right. You're also sort of free from the day traders out there, the individual day traders that would call holding a stock 3 days like an eternity. So you're sort of getting away from the effects of the day traders that can have an effect on your play. You're also getting away from the institutional crowd that can have an effect on your play. And you're sitting right between them. This space, this 2 to 10 day space, is the most competitionless, all right, period of the entire market. All right, when you start playing a little longer than that, you've got competition. If you start playing a little shorter than that, it's crowded too. You've got competition there. But if you play in that 2 to 10 day period, you have the least amount of competition and the least number of things that can interfere with the flow of your trade. And so that's what makes swing trading so unique. And a lot of people say, well, Oliver, should I be a swing trader? Well, yeah. Well, what about, should I day trade? Try to do that too. Should I play the markets long term like an investor? Yes. These things should not be choices. You should be deploying your capital over all the time frames. So it's not like, well, I'm a day trader, so I don't invest, or I'm an investor because therefore I don't day trade. I just think that that's wrong. All right. There's opportunities in each one of these approaches, and the true master might have some long-term plays that he's held for years and years and years, might do some swing trading on those long-term plays as well. All right. And the trader might even day trade. The trader might even day trade the same stocks that they swing trade, which are also the same stocks that they're holding long term. And that's hot. That's hot, traders. When you can hit a stock up in all three of your key time frames. I love that. I love that. All right. Cool. Let's see. Oliver, your knowledge on the next Black Swan event, is it possible? Is it possible it's over the petrodollar? First of all, you can't predict a black swan. That's an oxymoron, right? Like, it wouldn't be a black swan if we could predict what a possible next black swan could be. Black swan is just totally out of the blue, right? But I think what you're asking is, can there be a problem with the current petrodollar system that we're on? Yes. I believe that the petrodollar as a system has been weakening for years, right? And so for people who don't know what this is, right? August 15th, 1971, President Nixon took America off the gold standard. And what a lot of people don't understand is that that was actually a default. It wasn't America saying that we're defaulting, all right, on our we're defaulting on our promises, we're defaulting on our debts. They didn't explain it that way. But that's basically what it is. So countries were starting to get very nervous about the spending that was going on by the United States, and countries use the United States as a custodian of their gold, of their country's reserves, right? So the government gives you they receive the US government received gold from countries, held the gold on their behalf, gave them dollars. Dollars could be literally turned in for gold. And so countries began to say, you know what? I don't want the dollars anymore. Give me my gold back. And America started giving countries their gold back, but it just started getting out of hand. And one of the keys to understanding this is really interesting, that obviously there were more dollars out in circulation than there was gold to back it up. And America had to stop and say, look, no one else is getting their gold. No one else. All right? The dollar is as good as gold. Now we're keeping your gold. I mean, so literally that's really a default. Like, we know we said we would give you your gold back, but now you can't get your gold back. You just have to keep the dollars, and that's it. All right? And that happened in August 15th, 1971, right? What happened is that the dollar began to immediately weaken, okay? To help shore this off, what America did was create a deal with Saudi Arabia, right? That said, look, we will protect you. You can do anything on this planet. We will back you with our military. We'll give you access to to the best deals, the best everything. You're going to be our best friend, but you have to demand that every country in the world buys oil from you only with the dollar. So they can't buy it from you with the Russian ruble. They can't come to you with the Chinese yuan. Every country in the world needs your oil, but they have to buy dollars first, and then with the dollars buy oil from you. Saudi Arabia agreed. That started the petrodollar arrangement. So in a sense, the dollar stopped being backed by gold and was backed by oil. This kept an artificial demand for dollars. So it kept the currency strong, right? Because every country in the world had to buy dollars, had to get dollars. The demand for dollars, which was really the demand for oil, made up the American dollar truly, truly one of the best currencies out there. This system, I know it's taken a long time, guys, but this is important. This system is starting to break down because countries are increasingly wanting to sever themselves from having to use the dollar, all right? Having to go out and do business with America to get dollars, all right? And Russia wants to be off of this. China wants to be off of this. And the world is watching. The world is watching a scenario where it's increasingly becoming okay to maybe use another currency. And this is, in my opinion, potentially, we're on the last leg of the petrodollar. I believe that we're going to have a monetary reset and the dollar will go to zero. That's right. So all fiat currencies go to zero, guys. All of them. Some go to zero slower than others. So one currency might go to zero in 27 years. Another currency, it might take 150 years or 100 years. All right. But they all go to zero. And we don't call it going to zero. We call it a monetary reset. So if you see something like a country says, we're going to have a digital dollar, that's the old dollar going to zero. And then the new digital dollar is now the new monetary reset. So people think that the collapse of a currency is the end of a country. No, it's a monetary reset. They never call it the currency collapsing. They call it a reorganization. But that's your currency going to zero, because then otherwise, why would you have to reorganize something, right? All right. So, I think that I think that the dollar is over time in trouble. And I would be surprised to see if we still have the same petrodollar in 2035, let's say. All right, so it's not going to happen right away, but I do think that we drop. I do think we drop. All right. We are at, Iman is saying, yeah, we're at the 100-year mark. The dollar is finished. Yeah, I mean, all currencies are finished, right? But, it might take 20 years. I mean, think, guys, it's still relatively stronger than everything else out there, right? So, but what you're seeing cracks in the system by other currencies starting to blow up. And this is a sign it eventually gets to all of them. But the blow ups start to happen with the weakest currencies, right? So you'll see the fire with, like the Turkish lira, and you'll see, the Nigerian dollar, and you'll see the Venezuelan bolivar, and the Argentine peso. So you'll see the weaker currencies start to just collapse, right? But it starts with the weakest, and it eventually gets all the way to the strongest. And so I think that there will be another world's reserve system. Some people think that the possibility of Bitcoin taking that role. Some people think that perhaps we go on a system where we're backed by gold again, or perhaps a basket of currencies becomes the way it's done. Like, for instance, Russia's reserve was X number of dollars in gold. I mean, X number of value in gold, X number of dollars, X number of value in U.S. dollar, X number of value in the yuan, X number of value in Japanese yen. And, Russia was taking a basket approach versus I want all of my reserves in U.S. dollars or all of my reserves in gold. So some people think that the reset's going to be something like that. We either go back on the gold system, we either adopt Bitcoin, or we take a basket approach, and the world doesn't just run off of one single reserve currency. But we'll see. We'll see. All things lead to Bitcoin higher. I am telling you, everything I'm talking to you about now, I don't care what the reset is. This is extraordinarily bullish for Bitcoin, and it hasn't even begun to be priced in to the Bitcoin price. So consider it a gift, in my opinion. You should consider it a gift that Bitcoin hasn't even started to reflect everything we're talking about here, like a petrodollar reset and currencies continuing to blow up around the world. We're just starting. We're just starting. All right. So that's interesting. All right. Why do you, Chandra's asking, why do you average your position? We will lose more if we lose trade, else we will win small when. How to get rid of this? I'm not sure I understand that question, Chandra. I'm so sorry. If you can just kind of restate that in a clearer way for me. All right. Not sure I understand that. Boss, when we have a trailing stop with the 8-period moving average or the 13-period moving average, and the price goes near the 20 slowly, can pass to made trailing stop with your 20? Guys, you got to write better for me. You got to write better for me. This is terrible. Rewrite it, please. All right. Do you sell options regularly to generate some extra income with your wealth plays? Yes. Covered call strategy is an excellent way to augment some of your wealth plays. And there are two ways to do that, right? So you can, if you have a long position on a long-term play, when typically what I do is if my stock moves a certain percentage away from its 20-period moving average, right? It's overbought, okay? And the odds of a pullback have now gone up pretty high. That's a good point to start selling a covered call against the stock to collect the income. And if your stock gets called away, it's not a big deal. It's getting called away at a slightly higher price anyway. All right. And you can always reposition into the play on the pullback when the pullback happens. But the timing of this is important. You always want to try to have, you want to have a good method for determining when your stock is overbought. And that's the best time to sell covered calls. The other thing you can do is you can sell naked puts on a play that you're trying to accumulate or buy in the first place. So the best way to leg into a stock is to really sell the put. All right. So if you sell the put and the stock gets put to you, you want it to buy it anyway. And the price of your purchase is offset by the income from the put that you sold. So that's a great way if you're a long-term player and you want to play this stock on the long side, you want to accumulate, especially as it's moving down. All right. You should do the best way to get extra bang out of the play is to sell the put first. And you can also sell puts against your open position. All right. So if you come down, if your stock is coming down to that rising 20 period moving average, right, it's coming into a buy zone, right? You can sell the put. All right. Sell the naked put against it. And if you don't get put, fine, you collect the income from the sold put. But if you do get put, you want it to buy it near the 20 period moving average anyway. So these are great additional strategies that can augment some of your swing trading and your longer term play. Wouldn't do that for day trading. One of the issues with options is that I think there are two reasons why options are so difficult for people. Number one, guys, there's a 92% failure rate in trading. This is something that I will always put in your face. There's a 92% failure rate. That's right. You're either one of the 8% or you're one of the 92%. All right. Now I'm talking when I talk about this 92% failure rate, I'm talking about being able to do it for a living. It's not a 92% failure rate if you're just investing. I'm not talking about that. I'm talking about the group of people that want to try to earn their whole living from the market. There's a 92% failure rate with that activity. When you go to the options market, there's like a 98.9% failure rate. You make the game so much harder. If you're trying to do options for a living, I am telling you, that's almost like throwing money out of the window. Options are, and the reason for this is because number one, options are not ideal for day trading. They're ideal for augmenting some of your swing trades and your longer term plays. That's the proper use. The other mistake that a lot of people make with options is they go for the cheap options, and the way you increase your odds of success is to play the more expensive options. All right. The cheap options are where the odds are absolutely the lowest. All right. And there's a lot of games played around with cheap options, right? The cheaper prices. So you can't, the traders that do the best in the options world, they're playing deep in the money options. They're playing the expensive ones. All right. And they're not playing that hope game where, the price is so far away from, so those are the two main reasons. People are paying cheap. They're day trading, number one, wrong options, wrong. You're going to lose. It's like throwing money out of the window. Number two, you're playing the cheap options. You need to play the expensive ones if you want better odds. All right. Okay. As a day trader, what is your view on black pole trading, and when did black poles start in the market? Are you talking about black or dark pools of liquidity? I'm not familiar with what a black pole is, but clarify that for me. All right. What about using options to building up a small account? I'm telling you, the odds are very low. All right. Guys, options is the ultimate game of hope, right? And when it's the ultimate game of hope, I am telling you, you're being sold hope. And the sellers of hope will win 99% of the time. That's another thing about options. A lot of small accounts are buying options when the best strategy is to sell them. You want to be a seller of hope. You don't want to be a buyer of hope. All right? And if a small account is your problem, you need to go to a firm like mine and just get capital and just get funded. All right? You shouldn't be trying to take a little account and make a little account bigger. I know this sounds counterintuitive, but you're hurting yourself if you start learning this game with a little tiny account, because having a little account forces you to play wrong. And so what you're doing is training yourself at the time you're the most sensitive to learning. You're training yourself to trade the wrong way. And when the wrong way gets settled deep enough in your trader DNA, it's hard to reverse these things. How you start is very important. So a small account forces you to be fearful when you're not supposed to be fearful. It forces you to exit when you're not supposed to exit. You understand? It forces you to play what you're not supposed to play. Oh, I can't play Apple because the price is too high. I got to play this. So a small account actually pigeonholes you into being more of a novice trader. All right. The number one reason that most people fail in business, you know what that is? For lack of capital. This is the number one reason all over the world. The number one reason businesses go out of business. It's not the only reason, but it's the number one. They lack the proper amount of capital, right? They're undercapitalized. Well, what do you think the number one reason traders fail? Same thing. They're undercapitalized. They believe these stories out here that you don't need a lot of money to win in this game. And I'm sorry, that's not the case. You need money to play this game. You are not going to, with your tiny little money, you're not going to enter into my world and take food off of my table just because you have a Robinhood account. It's not going to happen. If you show up to the market and I show up to the market at the same time, I pretty much guarantee, and you're undercapitalized, you lose your money. I don't lose my money. All right? And so, guys, you've got to be realistic about it. Again, I tell you, there's 200 people here. There should be 20,000 people listening to this, but there's 200. Why? Because I talk to you about these things. I tell you what's very realistic in this space. And if you're playing with little baby money, you are showing up to a gunfight with a freaking little tiny toothpick, and you're not going to win that way. All right? You're just not going to win. You have to be properly capitalized, and you better have some training or some systematic method that you're applying. You can't just get out there with your tiny little account and your random acts of, I think it's going to go up, I think this is going to go down. That will never lead to anything consistent. All right? So you start here. You start right here on this channel, guys. You start right here. Your tactic is so simple and great. I thank you very much for that, Wakia. If I show someone your tactic, they laugh on me and show me something complicated. We have this tendency to believe that if it's not complex, it can't work. It's got to be complicated. But actually, guys, trading is the exact opposite. You see, the market is not a complex item, and you don't approach a simple item with complexity. That's where a lot of people go wrong too. They're assuming that the market is complicated, but if you think about it, the market is a relic. The market is pretty basic. It has three directions: up, down, sideways. That's not complex. If it had 2,141 different things that it could do inside of 5 minutes, that's a complex beast. But to tell me that the only thing the market can do ever is go up, down, sideways, repeat, up, down, sideways. That's it? That's complex? No, that's not complex. All right? This is a game of twos. All right? So you got two acts, buy, sell. You got two dominant trends, up, down, sometimes sideways. You've got two basic results. You're going to win money, you're going to lose money. I teach my traders there are two main moving averages. All right? 20, 200. All right? There's two states that your market has. It can be in a narrow state or a wide state. There are two positions. You can be above your key moving averages or below your key moving averages. This is so simple, right? I didn't say easy. That's different. But this is so simple that you don't have to even know how to count to three, because it's a game of twos. We don't get to three. All right? And we're making this game complex. We're bringing complexity to a simple game, and it's clashing. All right? And this is why, if you've noticed this, when you were the simplest, you made more money. So there, a lot of traders tell me, Oliver, I don't understand this. I know more today. I'm smarter than I was a year ago. I know way more as a trader now, and I make less. I used to make more when I didn't know anything. That is because you were simple. You have made yourself complex. All right? And the simple traders win. I'm telling you, the simplest strategies are the most powerful. The simplest methods work the most. Another reason why this is the case is that most of good trading is staying the heck out of the way. All right? You think that trading is always doing something when the best traders basically just hands off. They stay out of the way of the trade. They don't tinker with the trade. They're not constantly, every bar is not making them move. If you think about this, the simplest approaches keep the trader's hands off. Get your hands off the trade. Go to the bathroom. Walk around the block. Take your dog for a walk. Those will be your best trades. Now, how simple is that? Don't touch. All right? If you can find some approach some way to have good selection. So if you have halfway decent selection, all right, the rest is basically just get in and stop moving, stop thinking, stop moving, stop tinkering, stop wondering, and just let the thing, put your stop in and let the trade go. And so you'll find that the best traders do that the best. They stay the heck out of the way and let the trade do their work. I've always told you this, guys, if you follow my work for any period of time, I've always told you that this is a partnership, right, between you and the market. But you have two different jobs. You don't contribute what the market contributes, and the market can't contribute what you're supposed to contribute. So many traders fail to get this in their head, that your job is not to make money. Everybody's out here losing. Why? Because they're trying to make money. They're trying to find money. And that's not the trader's job. The market's job is to make money. When you buy a stock, it's the stock's job to go up. It's not your job. You can't push the stock up, right? You're not Warren Buffett. You can't put a few $1 billion into the stock and make it go up. You don't do anything to make the money. But what you're supposed to do is take care of the losses. See, your job is the loss side. The market's job is the win side. But you're trying to do the market's job, right? And you're leaving your job undone. All right? And if you focus on on just the loss, every trade you take, I'm going to focus on losing. You should take every trade and assume you're going to lose, but lose correctly. Say, I'm going to take this trade, and let's say your maximum loss is $60. All right. So you take this trade and you say, look, I'm going to lose $60 right on the nose. I'm not going to lose 59. I'm not going to lose 61. I'm going to get this right. I'm going to lose exactly $60. Now go. And guess what's going to start happening? You're gonna plan to lose your $60. You're gonna like, oh shoot, I just made $100. All right, let's try it again. You're gonna take the next trade. I'm gonna lose $60 right on the nose. And guess what's gonna happen? You're gonna stop losing $60. All right? Because you're focused now on the right thing. You're not focused on the money, you're focused on losing properly. Now, when I do this drill with traders, they get amazed. They're like, Oliver, I can't even lose right now because I'm trying to lose, and I had 12 winning trades in a row. I'm like, see, because you're focused on your job now, finally. Try that out. That might work for some of you. All right. How do you get funded by me? Guys, if you're interested in just reading through some of my funded programs, just go to olivervelez.com. All right. And it's there. Most popular program is still called the Self-Start Trader program. But I start every trader off with $50,000. You have to pass a test, obviously, but the test is reasonable. All right. You just got to show me that you can get out there and make $3,000. That's it. If you can make $3,000, that's not a lot to ask for with $50,000. All right. We go and we share the profits. All right. That's how it works. So just read through. All right. All right. So, all right, Ark, I think I've got your question now. Boss, when we're using the 8-period moving average or the 13-period moving average as a trailing stop, and the price starts to move back down toward my 20-period moving average, can we move on to trailing the 20 instead? Yeah, because, well, look, and if you're riding a stock and you're riding it with the 8-period moving average under it, right? You can't get to the 20 unless you break through the 8 first, right? And you can't get to the 20 without breaking through the 13. So which moving average are you trailing? I mean, it's like you're saying, well, I was trailing on the 8 and it breaks the 8. Then it breaks the 13. Can I just ignore those breaks and then go with the 20? You shouldn't be doing that. But you should know which one of the 3 to use. All right, so you got 3 key trailing moving averages, right? You got the 8, you got the 13, you got the 20. But every trend is not an 8-period moving average trend. Every trend's not a 13. Some trends are a 20-period moving average trend. Some trends are 8-period moving average. Some trends are 13. So they're one of the 3. And the way you determine which one is the last drop in the stock. So where did the last drop stop and rebound? What's the closest moving average to that bottom? And that's your trailing moving average. All right? Got it? I'm going to repeat that one more time. All right? You got 3 moving averages to trail with. The one, but you have to know which one to apply, because if you start trailing a trend with the wrong moving average, you're going to get taken out of a lot of good trades. So the way you determine which one to use is you go back to the last drop, okay, and rebound. Now, that bottom, right, where it rebounded from, which one is the closest moving average? Is it the 8? Is it the 13? Or is it the 20? And there you go. That's the one you use on that stock. All right, cool. All right. Oh. Da, 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 da. Our court's asking, what do you use for quick entries? Well, yeah, we use hotkeys. And Corey's saying that at Fidelity, he's using Active Trader Pro, which does not allow for hotkeys. Are you serious? That's crazy. In today's time? Guys, it depends on your style of market play, but when you start to play with real serious size, entries and execution skills are they almost become more important than anything else. Because if you miss 3 or 4 cents on a big position, that's a fortune. And you do that over years, you're missing 2, 3 cents off your trades, and you're a size player. That adds up over a lifetime if your executions are off, right? All right, adds up to huge numbers. All right, so we try not to lose a single penny, okay? And the quickest way to execute is hotkeys. You can't trade professionally with a mouse. I mean, now with size you can't. You can't you're not going to beat me to the supply, right, with this. It's not going to happen, okay? I mean, for swing trading, when your actions are days apart or whatever, but you can't just be clicking thousands upon thousands of shares like that. It just doesn't, you can't do it with a mouse, all right? So some of you have to some of you should be elevating yourself to setting up hotkeys. So you have profit taking hotkeys, you have entry hotkeys, right? And so you get into a play with one stroke and throw an order out there for sale with another stroke. And that takes you a split second. Dun, dun. All right. Whereas if the mouse trader it's just, you can't do that with size. That's all I'm saying. If you can get used to trading with hotkeys now, get yourself used to that now, that is far better than being a baby mouse trader. Wow. All right. Do you consider using support and resistance along with the 20 and the 200? Yes. All of these things can come together. So for instance, you can have a situation where a stock has run to a new high. All right. So it's past a prior peak. It's run to a new high. That new high is an area of support now. It drops back toward the new high, which serves as support. At the same time, the 20-period moving average is right there. So the 20-period moving average has risen to actually be right in the same price area as the former high, and your stock is coming down to the former high and the 20-period moving average. So that would be a scenario of 20 and price support, 20-period moving average support, and prior high price support are coming together to make that price area very powerful. Always understand that support and resistance is really nothing more than the concept of memory being built into the market, right? So support is an area where a collection of players got rewarded. That's why it's support. There was a reward there. All right. And resistance is just prior pain built into the market. Memory of pain is there. So that is why typically if a stock falls hard, violently from a price point. So let's say a stock falls from 100 to 92 hard. That $100 price area up there is major resistance because of the pain people experienced on that drop. All right. And there will 9 times out of every 10, there's going to be a reaction if we retest that 100 support. In the same way, if 92 produces a very powerful reward, all right, if 92 produces a powerful reward, then you're going to have support there. Memory, a positive memory is built into the market. So it's important to be able to read price support, but there are different types of support and resistance, right? So you got moving average support and resistance. You have price support and resistance. You have time-based support and resistance. There are times throughout the day where it's harder for stocks to move higher or lower. All right. So those are some interesting things. All right. Okay, I tried longing the market last year, but found that I lost a lot. This year I've been shorting stocks and I made way more money than I lost. Why is the market in favor for shorts? Because it's been going down for the last couple of months. That's why your shorts are working, you know? Yeah. So yeah, everything's been dropping. I mean, you can throw a dart today. I mean, over the last several weeks, it's been like the best last several weeks in a very long time for us, right? You could literally throw a dart and just short it. Whichever symbol, you could put a bunch of symbols on the wall, all right? And just throw a dart, and whichever symbol gets hit, just short it, and you're probably going to make money. That's how the market's been over the last several weeks. Now, you don't want to confuse a good market with skillful trading. So still, you got to be careful. Just make sure you're trading tight and you're neat. Like, you don't let trades get out of control. That's the number one thing you got to focus on, right? Don't ever let a trade get out of control. And you have to define what getting out of control is for you. All right. And I think I taught you this before in a prior Q&A session where I explained you take your maximum loss per week, you divide that by 5, that gets you your maximum loss per day. And then you take that and you divide that by 3 to get your maximum loss per trade. All right. Guys, my battery's running out here. So I got to run here, guys. But guys, great questions once again. Do me a favor, like this live session. Continue to show up, guys. I like doing this. I try to do this every single Monday. When I can't do it on Monday, I'll do it on Wednesday. All right, so that you know the schedule. But I'll try to do it on Monday. I couldn't do it. I was traveling this past Monday. But I like doing these things. Continue to show up. Continue to give me your questions. I try to scroll through the questions on my Twitter a little bit more. All right, so if you have a question you really want to get answered, go to my Twitter account, Velez 007, and type your question there. Even if it's days before, I'll comb through and try to get the questions done that way. All right, guys, so listen, thank you very much for showing up. All right, love you to death. If you haven't subscribed to this channel yet, please do. Make sure you click the bell in the upper right-hand corner, and so that you don't miss any of the content that we put out here, guys. All right, and again, if you're interested in anything we do, guys, anything, if you're interested in getting funded, interested in getting trained every single day, olivervelez.com, pick a program and let's go. All right, talk to you later. Ciao.